Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Joe Wilkins. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, FTSE Russell, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on futuresradioshow.com. Today I spoke with founder and CEO of R Best LLC, Joe Wilkins. We discussed Joe's path in the industry from floor trader in the 30-year bonds to now being a systematic trader. We discussed non-random, statistically relevant factors, investing based on evidence, being disciplined and keeping things simple, trading relationships, the first step that traders should take when building an algo. And last but not least, Joe shares one of his most memorable stories from being on the floor. So without further ado, let me take you right to the interview with Joe. Joe, you started on the floor in 1984, became a member of the Board of Trade in 1987, 30-year bond trader, top step scalper. 2002, you become a point-and-click trader. 04, you start developing strategies and indicators based on your style of trading. 07, you hire a quant, a data scientist. 2012, you started your CTA. Joe, you've done pretty much everything. Talk to us a little bit about your past and about what you've got going on these days with R Best LLC.
Yeah, so Anthony, as I said, I started in 1984 as a runner at the Board of Trade on the financial floor, and quickly realized that it was kind of my calling in life. I purchased a seat in 1987 and began trading in the pit that same year. It was a good career, a lot of change over that time, and as the late 90s came and went, electronic trading became available to us. I left the floor in 2002 because the writing was on the wall that the floors were on borrowed time. I kind of retired for a couple of years doing the point and click from home, and then in 2004 came back to begin a more systematic approach to trading. We followed that path for a couple of years, and that evolved in 2007 to onboard a full-time quant, and we got in data scientist. We then started into more research, data-driven, systematic, fully automated trading strategies.
You know what I love about your background, Joe, is that you are willing to adapt. You're willing to change to what the markets are doing now. Maybe I'm wrong, but it appears to me that you never wanted to live in the past. You always seem to be wanting to move forward, and what's the next opportunity?
Well, that's true. They say you're only as good as your last trade, and I believe you're actually only as good as your next trade. You got to stay ahead of the curve. In the pit, there was such a advantage being a member. Information flowed into the pit. Today, it's just the opposite. The advantage is in the data and staying ahead of information, if that's at all possible. You really need to anticipate these days, and that change over time, has taken the better part of my career.
Talk to us a little bit about your current strategy with all that experience that you've had in the past and why you trade this way now.
The most important thing is discipline in this business, I feel. And when you undertake a rules-based, repeatable advantage, when you discover, I should say, a rules-based, data-driven, repeatable advantage, a repeatable edge, it plays right into the need for discipline. Using simple, robust, quantitative models that have a repeatable advantage is never something that we had on the floor. And so since 2012 and a little prior to that, developing these models allows us to stay rigid, disciplined, and yet adaptive enough, given new data and new information, to stay, as current and, slightly ahead of the curve as we can.
So you say your strategy now is, your edging your strategy is data-driven research, intensive, systematic trading systems. Let's dive a little bit deeper into that. Explain to us your process. Explain to us how the strategy works.
Well, we develop a simple trading model, and everyone would be familiar with buy high, sell higher, or buy a pullback, wait for a market to take off, and then buy a pullback. That's basically what we do on an intraday basis. We trade our two main trading system, our flagship and our plus program, trade as intraday trading strategies. And so, it comes from a simple floor-based model. The bell rings and the market either goes somewhere or is coming from somewhere, or it doesn't go anywhere. And so starting with a simple model of, let's say the market's going somewhere, we want to measure how that market's going somewhere, whether it's going there quickly or slowly, whether it's building volume and momentum. And then our design is that we wait for a pullback to get in. We're not breakout traders. Of course, in that data and tens and tens of thousands of iterations of testing, we have discovered certain relationships, certain factors that test out to be statistically relevant and non-random. And so when you're dealing with non-random, statistically relevant factors, they don't need to be in what is practically a completely random, chaotic, non-structured system of trading of the markets. It doesn't take much of an advantage to put two or three of those factors together to get a true edge.
Okay, so it's intraday only, right?
That's correct.
What markets are you focusing on?
Our flagship program started as a treasury and equity program, so the 10-year treasury and the S&P. We recently dropped the 10-year, and so now it's a simple equity program, just focusing on the S&P E-mini. That occurred simply because of the interest rate environment and the lack of volatility in the treasuries. We call that a private client institution program. And then our Private Client Plus program takes that flagship program and adds to it the metals, copper and gold, the energies, nat gas and crude oil, and we pick the euro currency as our currency. So the Private Client Plus program trades across 5 sectors and is more of a portfolio type strategy in the long run. And then our flagship is just focuses on the S&P E-mini.
One thing you said that stuck out to me about your strategy is that you look for non-random factors. Could you explain to us what a non-random factor would be?
Well, in the markets, movement is practically random. information comes in and the market moves in what our brains perceive as a pattern, when in fact, when you put it through the ringer and you try to find statistical relevance, there is none. It's it's practically completely random. There are, however, a couple of relationships when you start to put a couple of things together that end up being non-random to a certain degree. So it's kind of hard to explain. The randomness is tested. How we test that is we take all the information that we derive, the relationships that we test, and then we take those and we test them against random sets of data. So you could take, 2012 and run your strategy throughout that year, and if that's the data you use to develop the strategy, you're going to come out with a profitable trading strategy because you developed it on that data, you ran it on that data, and you're going to come out with a nice profit factor. What we do is we take our relationships, our factor relationships, and test them in sample, out of sample, and with clean data sets. So what that means is that we will put together a clean data set that is made up of a small amount of data from the past 20 years, and then we mix it, over 10,000 times. We do Monte Carlo studies that takes data in and out of sample many, many times and runs the strategy practically as if it were new market information coming in. And so, we try to do the best we can to have factors that are, like I said, non-random, non-curve fitted, developed over 80,000 iterations of market data across 28 markets, so that we can lessen any type of curve fitting or random factors that we have.
So when I go onto your site, in big bold letters, it says investing based on evidence.
Right. We need empirical evidence. We need, like I said, regularly occurring inefficiencies in the market that you can only find true inefficiencies if you're looking at relationships. So we take, simple relationships, volume, momentum, a few other proprietary indicators that give us an edge. We like to keep things very simple here because you can overcomplicate the heck out of the markets, and that's what our brains want to do. And when we say we're disciplined, like I said, one of the advantages of systematic trading is that you take the same swing every time. And so, we believe it's a numbers game. So the higher amounts of trades that we take, the more it's just like having the advantage in Vegas as the house. Over any short period of time, the market may win, but if we play enough rounds, the house is going to win, and we like to be the house.
Can you explain a little bit more about how you're using relationships?
Sure. So there's certain volume. I'll just start with let's say a momentum. So if a market is creeping its way higher on low volume, there's not a lot of interest in the follow-through. These are very general terms, Anthony, very generally stated. But, if you can imagine a market just creeping higher 1 minute at a time and very slowly, or even like 5 or 10 minutes at a time, it makes a little 1 tick new high and a 1 tick new high, and there's not a lot of volume, there's not a lot of follow-through. We're not going to be interested in purchasing that market. If, however, and conversely, if you get a spike as a high, a very high momentum move, sudden high momentum move that may be on very high volume, we're not going to be very interested in that either, because we found those to be very short-lived. If, on the other hand, there's a nice moderate pace, a kind of a good hum on the floor, we would hear the phones ring, the noise level would pick up, and there'd be a nice hum in price action. Here we measure momentum all very objectively. So if there is a nice moderate to robust pace of volume that continues at, let's say, higher prices, and so there's a nice volume, there's a nice momentum to it, more than likely our algorithm will measure that to be a potential buy, in which case orders will go in to purchase a pullback, assuming it's a buy. Stops go in immediately as well to protect our downside and our risk, and then we basically let the trade play out.
It was funny hearing you say that if the market's making a high or a low, you would hear the phones ring, and then you'd hear the noise in the pit get a little bit louder. And that was one of the main reasons why even me as a screen trader, I stayed on the floor, because I could gauge whether the market was busy or slow, but just by the sound.
Mm-hmm. And it's one of the adaptations that we've had to make, and why, it's funny from two former floor traders, let's say, how the business has evolved to be such data-driven, research intensive. Now the traders are data scientists. Now the best hires all come from a machine learning background, quantitative background, because there's less feel to the market movement. Let's say there's less feel to the market movement, and there's a whole lot more inside in the data, whether it's a high frequency data inside the book in the volume of bid and offers, or in the low frequency environment where you're measuring, like I said, momentum, volume relationships, how the day is evolving on just a volume analysis. I'm sure everybody's familiar with market profile, but the relationships in volume at higher prices or volume at lower prices is a good indication of whether a market's trending or not. And our strategies are looking for sustained momentum moves, which is why I was saying before, a spike isn't going to do it for us, and a creeping market isn't going to do it for us. We're trying to catch a nice moderate pace that indicates it's going to continue throughout the day.
It sounds to me as though the strategy is very reactive, right? If X happens, we're in.
Well, it's constantly measuring. So one of the things we do is we measure the overnight action. We start the strategies are measuring things since the 5 o'clock p.m. open up until 4 a.m. And our strategies, our plus strategies begin at 4 a.m. Our S&P strategy begins at 6 a.m. And what that does when they start, they're already accumulating the data from the overnight. So they're looking at volume, they're looking at momentum, they're looking at the relationships that they indicate time and so forth. And when we let them, when they start, let's say the S&P begins at 6 a.m., it's already measuring everything overnight, and then throughout the day. As things evolve, the algorithm evolves with it.
So you're a low frequency algo. Is that right?
Correct.
Okay.
That's correct.
I'm curious, with all of your experience and all of what you've seen and you've done, why is this the route that you've chosen to take? Well,
I think that it's really a cost-effective way to capture return. There's the likes of Citadel, talk about being the house. There was a race for speed, to basically light speed, and we got there. Back in the day, I'd say in the aughts, everyone was trying to go from fiber optic cable to fiber optics to T1 lines to to eventually microwaves, setting up towers, transatlantic cables, everything to get that speed edge. And we saw that as a race to zero. And in that race, there's been a few small players that have, large players, I should say, that have won that race. We didn't feel we could compete, so we went to the other end of the spectrum. And there's another fundamental thing to that. I like the markets. I've never been a speed guy, let's say. I actually like to see how markets evolve and their fundamental nature of finding fair value. So as long, one of the things that I've always believed in, as long as there's freely traded markets, price discovery is its main function. And so as new information comes in, then there's going to be a bid and offer, and they're going to go places. So that's kind of what we want to capture. We want to capture a little bit more of the macro movement than the micro movement.
Hey everybody, I want to take a moment to thank one of our sponsors, FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-mini Russell 2000 Index futures, contract symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. So Joe, you've been through this process of developing your own algo, taking yourself from a floor trader, point and click trader, to now a systematic trader. What would your advice be? What would the first step that a trader out there listening to this should take if they want to develop their own algo?
First, structure your trading. I guess if we're going to start at zero, structure your trader. Get a really good understanding of how your outlook of the market can be structured. Whether it's, like I said, buying new highs, selling breakouts, buying pullbacks. The initial thing you need to do is structure your trading. You're dealing in a completely unstructured random environment. So you really need to get your ABC on what your trade looks like, what your risk is, what your profit factor is, and start with that. Then you can figure out what you're looking at, what factors go into that to either make a profitable trade or the trades that lose. So keeping track of your structure is probably the beginning point. Developing and keeping track of your trade structure is probably the starting point.
Going back to your strategy a little bit, are all of the trades always the same contract size, always the same distance of stop, always the same distance of target? Talk to us a little bit about that.
No. We target a percent risk per trade. So let's say we risk 0.5% per trade, in which case our trade size varies depending upon how distant the stop is from our entry point. And then that does stay pretty constant. The only thing that changes is our position sizing.
And then what about for targets? If something's going your way, are you just moving that stop up? Do you have a set target in place every time?
Yeah, if something's going our way, well, first of all, we have between a 2-to-1 and 4-to-1 profit target, and yes, as the market continues to go our way, our stop moves with that. So overall results are less losers, more winners, and then that's what we're looking for.
Joe, before we get into rapid fire today, you were on the floor for a long period of time. How about you sharing with us one of your favorite stories from the floor?
Well, one of my own personal stories was, on the floor, you could easily get in over your head. And as I said earlier, the 90s were the late 80s and 90s were quite the cowboy Wild West in the bonds. And I was a moderate sized trader. There were much larger traders than I, but every once in a while I would tend to accumulate a position and get stuck with more bonds than I wanted. And there was one day that I kind of buried myself as the market was dropping. I bought some at I don't remember the prices. I actually do remember the prices. I started buying it at like 04. It was dropping to 02. I lost my discipline. I bought some more at 30. I bought some more at 28. I ended up having well over 1,000 bonds on, and was facing quite the bad day. And suddenly, all at once, some news came out where the largest broker in the pit, Dave Ryan, the market was trading like 22, 23, and all at once, David Ryan just came out and said, even bid, to which I dumped 500 immediately, dumped 500 more as soon as I could, and got myself flat and basically scratched the whole trade. And 2 minutes later, the market was trading about 2 points higher. It would have been one hell of a profitable day, and I was just happy that I still had a job the next day.
Great stuff, Joe. We are not done yet. We have rapid fire questions next if you're ready for those.
Uh-oh. Hit me.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You can try it now for free at tryttnow.com. Joe, first question for you. What trader has influenced your life the most and why?
Actually, there were a couple. One is the late Terry Cullerton. He was a top step trader, one of the first large traders in the treasuries when they first came out in the late 70s. He taught me, he was such a disciplined trader who also learned his discipline through mistakes, that he would, if the market backed up 2 ticks, bar none, he was out. He didn't matter what was happening, what his position was, how big it was. If the market moved 2 ticks against him, he blew out of his position 100% of the times. And that really influenced my discipline.
What was one of the hardest things for you to overcome in trading?
Well, in the early 2000s, when the electronic markets took over the floors, disidentifying as a trader in my late 30s was a very difficult thing. Having had a 10-year run as a trader, kind of the swagger that we had on the floor, when that dried up, and my income producing skills were no longer applicable, I really struggled with my identity as a person, and I can go on and on for that. That's a long conversation, but trading isn't everything. Making money isn't everything. Learning that you're a good human being is far more important. And actually, when you learn that, your trading improves.
100% agree with that. How has your trading process evolved over the years?
Well, from a pretty haphazard floor scalper, buy it at 1, sell it at 2. If it goes 1 sellers, get the heck out, to a short-term position trader on the floor. I realized that I could pick prices, pick areas of resistance and support, accumulate a position in those areas, and then ride winners for a longer period of time. Actually, that helped my bottom line quite a bit in the early 90s. And then, back to short-term electronic trading, as you did, Anthony, scalping, day trading electronically, to now fully systematic automated trading. It's really evolved through the years, but the same disciplines still apply.
What is one attribute that you believe every trader should have?
Discipline, structure, and discipline.
Favorite book about trading?
Disciplined Trader by Mark Douglas.
If you had to pick a profession other than trading, what would it be?
I struggled with this one, life coaching. The experiences that I've had for the last 30 years in this business have made me a different person than I was when I started. And if I can share that with other people, that would be just very rewarding.
What's the best piece of advice that you've received about trading?
Make money. I had a mentor once tell me, scratch or make money. How long do you want to do that for? And I was a young man then, and he kind of hit me in the head, and he said, forever, right? And I said, I guess so. And so that's pretty much what we do here. We try to manage our risk, scratch, make money, and manage not losing. Let's put it that way. The winners, as the colloquial wisdom says, take care of your losers, and the winners take care of themselves.
If you could go back in time and give the younger you a piece of advice, what would it be?
Go into a different business. No, I'm just kidding. Be diligent and purposeful. That's one of the things. I actually have a sign on my desk that defines diligence, and it's painstaking perseverance, painstaking effort, and that's what it takes in this business. It takes a real commitment to be purposeful, to be structured, and to be disciplined. I also, I'm a big believer in action is where it's at. Talking about things doesn't make a difference, but so you have to take action, and you can't add a lot of meaning to it. Trading and the results you get are just trading and trading results. You had a loser, so that happened. You had a winner, so that happened. It doesn't mean anything about you as a person. It just means what it means. It just is what it is. And so if I had to share that with a younger version of myself, I'd emphasize discipline and purpose, and just taking the market for what it is, and that nothing is personal.
If you had an elevator pitch me your edge in trading, what would you say?
Our best programs have a non-random statistical edge that work to exploit opportunities over time. It's a numbers game.
Last question for today. What's your favorite thing to do when you're not trading?
Good question. Well, besides being with my family, I really enjoy reading and a good cigar.
Joe, where could people find you on social media, preferably Twitter, and give us a website to check out?
Sure. Our Twitter site is @ourbestcta, and our website is www.rbestllc.com.
Joe, this was awesome. Man, I had such a good time speaking with you today. Thank you so much for joining me today on Futures Radio Show.
Thank you, Anthony.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.